How do you know if you're gambling with your money or you're actually making a smart, prudent investment decision? Are you a gambler or an investor? We're gonna talk about this simple equation that's gonna tell you exactly whether or not you are and how to avoid being a gambler and start to be an investor. Hey everyone, I'm Rosehart. Welcome back to my channel. I hope you're having a great day. Today we're gonna explore whether or not you know if you're a gambler or an investor. How do you know whether you're gambling or you're actually investing? The math's actually simple. There's an equation to determine whether or not you're just gambling with your money or you're investing. Bitcoin, gambling. Cryptocurrency, likely gambling, but we'll get into it in a bit. Okay, so it's really important to think down, how do you determine whether or not you're a gambler and whether or not you're an investor? So I think the best way to do that is to jump over to the whiteboard here and to give you the equation, and then we'll dive deeper into how you make really prudent decisions around becoming more of an investor. Because investors make money always. Investing is boring, but you make a lot of money. Gambling is exciting, but you're probably gonna lose money. There's a negative expectancy. And we're gonna get into that in a sec. So let's jump over to the whiteboard. First things first. How do you determine it? There's a simple mathematical equation. It is matter of fact. You're either a gambler or an investor. How do you determine it? Expected return. Basic first year university stats. Probably covered this in high school. I know I for sure covered this in my first year university stats course, but expected return. If you guys remember, it's probability times payout, right? Gives you an expected return. You can quantify your actual return before you go into whatever it is that you're investing in. Now, trying to figure these out is where the assumptions come in and all of the data and analysis to determine the exact probability of the payout. But essentially, it's the probability that you're going to make money and the amount of money you're going to make. So you can do several different expected returns equations and then average them all together or give them different weightings. I have spreadsheets where I've done different expected returns and weighted each one proportionally. The idea is this. Think of flipping a coin. If you flip the coin, heads or tails, it's a break-even expected return. Your probability of whatever choice you make is 50%. And your expected return or payout, whatever it is, say it's $2 every time you get a win or $5 every time you win. You're going to win and lose equally. There's a 50% probability. So your expected return is $1, or actually it's 0 because you lose 50% and you win 50% of the time. That's a gambling. Gamblers often have negative. So break even, flipping a coin is not really gambling because in gambling, the house always wins. There's actually a negative expected return. When you put it all on red, when you buy that penny stock, you are gambling. So let's look at some examples of where you'd have a negative expected return likely. And we can talk about how you go about trying to quantify these. But the idea is this: if you're a gambler, likely you're gonna buy a stock or a property that you like. There's gonna be emotion involved. If there's too much emotion involved and you like the property, you don't know why you like it, it feels good, you go in there, it feels like you're home, and you're buying an investment property that you like, that's a mistake. People do the I would live here test when they're going through a property. That's often a mistake. There are better ways to quantify the finishes than say, I would live here. If you like the company, people are like, oh man, I love my Adidas kicks. I love my Nike kicks. Oh, I love my Lululemon pants. I'm obsessed with my Apple computer. I'm gonna buy stock in Apple because I like the product. I like the company. Liking it is gambling. Or you're gonna buy a property and say, hey, I think this area is gonna appreciate in value. I'm gonna speculate. Hello, gambling. You aren't in control. There's a negative expected return. You aren't in control is the biggest thing. Investors are in control. They rely on data, facts, spreadsheets. They control the outcome in their favor. Before they invest, they know they're going to make money. That's why it's so boring being an investor. Whenever I buy a property, I know I'm getting a 25% return from rental income, from cash flow, from being able to add value to the property. I assume appreciation is 0 when I buy a property. A lot of guys in the real estate world are like, oh, I'm putting in 5% appreciation, 3% appreciation. That's a mistake. That's gambling. If all you're investing in real estate or stocks for is the upside appreciation and you don't have any control over that, you are a gambler. Let's look at some more examples. So your friend tells you to buy a stock, your fellow investor tells you to buy a company or a stock or a property, and you listen because your friend said. Your investment advisor says, hey, buy shares in Apple. If there isn't good data and rationale and facts, their opinion alone isn't enough. Don't trust what your realtor says. Don't trust what your investment advisor says. And definitely don't listen to your friend. Be an investor, not a gambler. You'd be gambling on your friend's advice. That isn't the kind of thing we like to trade on. That isn't the way you make money long-term. That isn't smart, prudent investing. And I want to teach all you guys on this channel who've been following me in this journey about how to become investors, not gamblers. So stop buying companies because you like them. Stop buying properties because you think they're going to go up. You think that the area is going to appreciate. Stop buying because a friend told you to buy in this area, because a friend has a property there. Stop buying because your investment advisor told you to buy there. Another thing is like, because the company has good prospects. People do that all the time. They say, oh, I think Apple has good long-term prospects. Did you look at their financial statements? Did you crunch anything? Have you even looked at the probability of success? What is your expected payout? Well, I don't know. I just think it's going to go up. Gambling. If you gamble, chances are you will lose to the market. You'll probably lose your money. A fool and his money are soon parted. So don't be a fool. Don't be a gambler. What are the signs of being a gambler? Well, one, just like going to the casino is an obvious one, buying scratch tickets. Don't do that. They make so much money at the casino because it's not in your favor. There is always a negative expected return. If you're planning to retire based on the lottery, which interestingly, I read an article, I can't remember the stat now, but something like a large percentage of Americans were relying on a huge windfall, like an inheritance or winning the lottery to retire. Like, what? Gambling. There's a reason people don't make 10,000% return on their money without a lot of effort. It's because, I'll tell you what, it doesn't happen with a very, very low probability. If your probability is like 0.000, like the lottery, a very small percentage chance of winning, even if your payout is 10 million bucks, it's not a good decision. You got to have a positive expected return, right? Really important to have that positive expected return. So what are some things that you could tell that someone's gambling? Or maybe you have a loved one that's gambling with their investments. You say, hey, auntie, you know your house in Vancouver? Hate to tell you this, you're gambling. Do you have expected return? Gambling. Okay, so no control. If you have no control over the investment return, so for instance, the housing prices in Vancouver, if you have no control over that, I mean, maybe if you're like Donald Trump or you're like the president, like if you're the prime minister or you're on council, maybe you'd have some weight and you could actually affect the outcome of housing prices in your area. You could pass bills if you're on council, or you had some insider information you were trading on, you could quantify that and become an investor. Then you have an expected return. But if you're buying, you have no control, hey, guess what? You're a gambler. You're a real estate gambler. Probably going to lose money long term. You might make a ton of money. There's a lot of real estate gamblers who've made a lot of money. But over the long term, you will lose. Your expected return is negative when you don't have control. So I want you to have the best return you can have. So get control of the situation. When you invest for rental income, you can place a tenant at market rent. If you work hard, you get cash flow. You put in the effort, or you hire a manager to put in the effort for you. You rent it out, you get a guaranteed return on your money. You buy a property at 80 cents on the dollar. You have 20 cents of margin. You spend 10 cents on the dollar renovating it. You make 10 cents on the dollar, even if the market's flat. You're in control. You put in the renovation capital, you follow the plan, you get the return. There's a really high probability of success. Almost all of the investments I've ever invested, pretty much everything I've ever invested in for the most part, has a very, very high probability of success. The higher the probability of success, the better, right? Then the payout is also important. Obviously, a higher payout's better, but I'm more concerned with not losing money. The worst thing you can do is lose money. And so as investors, we have to preserve our capital. That means we don't want to lose it. So the higher the chance of making money and not losing money, the closer you are to being an investor, the higher the chance of a positive expected return. If you have a very, very low probability of success, your expected return, if you play the game 100 times, it's going to be negative. You're going to lose money. You're a gambler. Next thing is no data. People buy because they hear their friend tells them Vancouver's going up. They watch one article, one media article about Vancouver houses prices being high and people doing well. They talk to another friend who made $1 million owning property for the last 20 years in Toronto or in LA. And their investment advisor says, yeah, Vancouver real estate's been hot. None of that is data that suggests you should buy now. In fact, the real estate market being hot might actually be, if you think through it, a negative thing and actually be a sign to not buy. An investor might not want to buy when the market's hot. They might want to buy when it's cool. No data, no control, and no spreadsheets. A lot of people are buying properties without doing any numbers. I talked to a real estate investor the other day. It's like, yeah, I don't do any numbers. Just buy the property because I like it. It's like, hello, real estate gambler. Don't be a real estate gambler. Like, don't do it. I'm wearing this Waldo shirt because I don't want you to do it. I want you to find me on the internet so I can teach you over social media like at Mike Rosehart on Instagram or on my YouTube channel or on Facebook about how to invest smartly, how to make money in real estate consistently. I'd rather hear from my investors that none of them have lost money than hear that a few of them have made a ton of money. It's why I don't teach affiliate marketing. It's why I don't talk about those high-risk strategies like trying to resell on Amazon, because most people fail. It's why I don't talk a lot about entrepreneurship before you've made it, because most entrepreneurs fail. The probability of success is low. Doesn't mean you don't go into entrepreneurship. It means you get your savings in order first, you build a good financial base, then you jump into entrepreneurship, right? You make calculated, smart investor decisions. You don't just jump out and do things. That's what gamblers do. And gamblers often lose. Pretty much always lose. There are a few gamblers who will win, and people jump in the comments and they'll hang on to that and say, but oh, my aunt, she made $3 million in LA owning property. It's like, that's great. Does she have any control over that, or is she just lucky? Investors aren't lucky. They're calculated. They make money always. Gamblers are lucky. Investors are calculated. They don't get lucky. They build it into their model. They're going to make money whether the market goes up or not. And it's okay, so no control, no data, no spreadsheet, and a negative expected return if you look at the equation to determine whether there's going to be a probability of a good payout at the end of the day. So going into your investment decision, you should know whether you've made money on day one. If you don't know, you're probably gambling. If you know, go back and check your numbers and make sure that your assumptions are right. Because some people go in and buying Bitcoin saying, I got a 99% chance of making tons of money in Bitcoin. Probably like a 10% chance, a 90% chance of failing and losing everything, more likely. That's just the risk of cryptocurrency over a 20-year period, right? It's not a really safe thing that I feel comfortable about. That's just me. Some investors are going to have different assumptions. They might think the probability is a little bit higher. They may think the expected payout is so high that it justifies a low probability. For me, it's about a high probability of success. So that's why I invest in real estate. That's why I invest in safe things like fixed lending against real estate or fixed lending against businesses or buying equities that are very diversified, because the probability of payout is very, very high. Even if the payout's low, maybe a few $1,000s, I'd rather have a guaranteed few $1,000s than a very minuscule chance at millions, because that's gambling. We don't want to be gamblers, we want to be investors. Get rich slowly. Don't lose money. Those are core foundations that every investor who's successful, their foundation should be built upon that. So that's what I recommend for you guys. Anyway, hope you enjoyed this video. If you did, smash the like, and I'll see you in the comments talking about, are you an investor or a gambler? And do you calculate expected return? If not, you probably should try to quantify that. I like to go for a triple tier punch. I like to look for 3 ways to make money in every investment. And I always look for 3 exit opportunities as well. Most people just go in with no exit opportunities, like, I'm gonna sell this Bitcoin to someone else for more money. That's the only exit with Bitcoin. I know I'm hitting on Bitcoin pretty hard. Don't necessarily hate Bitcoin, but it's a good example of a high risk investment. Same isn't true in real estate. People buy real estate with no cash flow, like negative cash flow in like Vancouver and LA, and they're like, oh, my only hope is to sell it to someone else for more. That's one exit strategy. It's not a great one. So don't be a gambler, be an investor. I hope you enjoyed that video, everyone, and I hope that through this video you've realized, hey, maybe I'm doing a little bit more gambling with my investments than I thought I was, and maybe I should become more of an investor than a gambler. If you got value from this video, I'd love it if you smashed a thumbs up and you jumped in the comments and said, hey, I was a gambler on this past investment because I was betting purely on speculation. Now I've made a change. That would mean a lot to me. That's why I make these videos. I don't do it for the money because I don't make a whole lot of money from it. It's more to help. And so I want to feel like I'm having an impact on your life. So please let me know if I am having an impact. And even if I'm not really having a big impact, let's start a discussion down below about how you decide your investor strategy and how you know that you're going to get a positive expectancy on the money that you're investing. What are you doing differently? And maybe I can learn something new too. The secret to unlocking a wealthier you is to spend less, earn more, and maximize the returns on the difference. That's it. It's dead simple to become wealthy. It's boring, it's slow, and it works 100% of the time. You can build wealth, you will be a wealthier person if you can master that simple equation. Spend less, earn more, and maximize those returns. Bye, everyone. Done. Done. How do you tell if you're gambling or investing? Gambling. Hey everyone, I'm Mike Rosehart. Hope you're having a great day. Gambling. I should film the outro. Do you know if you're gambling or investing? Gambling. Don't do it. Oh, this marker sucks. Cool. Okay, let's do this video, get it over with, and then we'll chat about that. Go downstairs and chat about that. Gambling.